Hello, everyone, and thanks for joining us today for part 4 of our webinar series, An Introduction to Crypto Investing for Professional Wealth Managers. I'm Daniel Tardent, Head of Marketing at Blockchange, and today's topic is creating a crypto portfolio. So now that we understand the use cases for digital assets and the fundamentals of crypto investing from the previous webinars, it's time to put that knowledge to practical use by learning how to create a portfolio. We'll be starting in just a few moments, but a couple of admin items for you. So first, we will be answering questions. So if you have a question, please enter it into the Q&A tab and we'll answer as many as we can at the end of the webinar. Secondly, we are recording today's webinar, so by participating, you're giving your consent to being recorded. And finally, a disclaimer, the information presented today is for informational purposes only and should not be relied upon as the basis for investment decisions. Okay, so that's admin out of the way. Now, in the past few weeks, we've covered some interesting ground from the basics of cryptocurrencies through to the fundamentals of crypto investing. But we haven't really discussed the why. Why did we put this webinar series together? And why should you, as a wealth advisor, care about the whole area of crypto assets? So before I hand over to Dan and Griffin, I want to touch briefly on these questions. A big part of the motivation lies in generational shifts, particularly with millennials. What we know today is that millennials are investing actively, but they're somewhat different to previous generations. For example, did you know that 90% of millennial investors prefer Bitcoin to gold? Or that 50% trust cryptocurrency exchanges more than stock exchanges? And these data points are based on anecdotal evidence from CCN and Cointelegraph. And if you look closely, you'll see the dates on those articles are very recent. In other evidence, a 2019 report from Charles Schwab found that Grayscale's Bitcoin Trust was one of the top 5 equity holdings for millennials, beating out popular equities like Netflix and Microsoft. So millennials clearly have a strong desire and preference to invest in digital assets as an option. From a performance perspective, we've covered some of the strengths of crypto assets in the previous webinars. But let's look at a couple of the high runners. So first of all, digital assets like Bitcoin have demonstrated standout performance over the last 5 years compared with conventional stocks, and with less downside volatility than gold or the S&P. They also play a key role in mitigating portfolio risk because they're not correlated with traditional asset classes. And this is something that Griffin spoke about at length in webinar 2, if you'd like to go back and review that. So there's a significant market demand for digital assets, particularly among millennials, and some very strong reasons to include them in a portfolio mix. And RIA firms recognize this opportunity. Late last year, we commissioned a research firm to conduct long-form interviews in the RIA space to gauge interest in crypto assets. They surveyed 250 firms ranging in size from less than 5 to more than 500 advisors. And here are a few key data points. 25% of firms expressed interest in offering crypto exposure to their clients. 92% believed crypto's addition to the CFA exam will accelerate adoption. And the same percentage believe crypto has created an opportunity to differentiate their offerings to clients. Okay, so what does all this data tell us? Well, the bottom line is that as a professional wealth manager, you're going to miss out on a big opportunity to expand your client base and grow your assets under management if you're not paying attention to digital assets. Maybe not right now, but for sure at some point in the not too distant future. So that's why Blockchange exists today, and it's also why we think understanding the digital asset space is so important for advisors. So that's the why. I did also want to mention that you will actually see the Blockchange platform a little bit later in the webinar when Dan's doing his section. Okay, so let's get started with the main part of the webinar. And just to restate, today's topic is creating a crypto portfolio. Our presenters are Dan Eyre, who's the CEO of Blockchange, and Griffin Knight, who is our head of product. So now I'll hand over to Griffin to get you started. Thanks, Griffin.
Thanks, Dan. Hey everyone, my name is Griffin Knight, and I'm the head of product at Blockchange. I have a background in finance and previously worked at a management consulting company that focused on firms in the alternative investment space. I've also been a longtime crypto enthusiast. And so, I hope you're able to get something out of this webinar, which attempts to kind of wrap together a lot of the concepts that we went over in the first three. So in this webinar, we want to walk through the steps for actually building a crypto asset portfolio. So first, I'll dive into the classification and taxonomy of different crypto assets, and then we'll discuss making and managing the investment. So let's look now at classification and taxonomy. So before we go quite too far into this, I want to do a quick overview. So investments in crypto assets, especially the smaller ones, is definitely more akin to making a VC investment or an investment like a VC would, as opposed to traditional equities. So what I mean by that is that the lion's share of the gains will most likely be coming from just a few of the assets. Additionally, many of the concepts in some of these assets are novel, and each one can be trying out different mechanisms when it comes to their technology or their game theory. Some of the attempts, though, will surely fail, but the ones that get it right should be able to capture a large amount of the value. And really, for this reason, it's important that we maintain a portfolio that contains a grouping of crypto assets. This is especially important for those who are newer to crypto asset investing and know less about the ins and out of all of the existing projects. However, diversification really only helps us for crypto assets within the same group. So for example, Ethereum is little affected by the success or failure of Bitcoin Cash because they're not competing for the same thing. So now let's go through a very simple classification exercise and try to group our crypto assets accordingly. So this is a basic framework that we built of one way to think and one way to group crypto assets. So remember that the purpose of this exercise is so that we can group assets together in order to achieve a meaningful level of diversification when it comes to the specific use case. So also note that these classification systems are very fluid and there are many different ways to do it. I found this particular structure as a good high level way to look at it, but if you're interested in doing so, you can definitely do additional research because there's really a ton of different ways you can classify this. But in addition to the groupings, I wanted to walk through 16 different cryptocurrencies that go or that really fit into each of these buckets. And really the intention here is also to familiarize you with other crypto assets outside of just the mainstream ones. So with that, we will look at the first subgroup of the currencies bucket, which is store value and medium of exchange. So while we went deep into this use case in webinar 1, just as a quick reminder, these cryptocurrencies are aiming to become a form of digital cash that can be used as a non-sovereign store of value and also a payment method. I've outlined 4 of the largest that are vying for this use case. Now, I want to point out that not all of these are perfect substitutes. However, for the most part, the success of one will mean less success for the others. So first we have Bitcoin, which was the first cryptocurrency created in 2009. Bitcoin is currently the largest and most prominent crypto asset, and in turn has the highest chance of success. However, that is also reflected in the size that it currently stands at, which is 67% of total cryptocurrency market value. Next, we have Litecoin, which was created in 2014 by Charlie Lee as the silver to Bitcoin's gold. It copied 99% of Bitcoin's code with a few alterations, and it's really primarily used as a payments rail, as the transaction fees are less than that of Bitcoin. Next, we have Bitcoin Cash, which was forked from Bitcoin in 2017 due to a difference of opinions that existed in the Bitcoin community. So on a quick side note, I just want to go into what a fork is, because especially as you get more involved in the space, you'll see assets like Bitcoin and Bitcoin Cash. And a very common question I get is like, well, what's the difference? And so really what it is it's a result of a fork. So a fork occurs in a cryptocurrency when the group of participants that are maintaining the network disagree on what the rules and how that cryptocurrency should work. When this happens, they fork into a separate crypto asset altogether. Sometimes when the community is large enough, the asset can exist on its own and even flourish. So that's what's happened with Bitcoin Cash. The concept of community support is very, very important. And very few forks ever end up accruing any value. I mean, you can think of it as an example. If I decided to fork Bitcoin and call it Griffin Coin, it wouldn't have any value since no participants outside of myself would ascribe any value to it. Anyway, the gist of the differences between, well, in Bitcoin Cash's community was that they felt Bitcoin should scale to facilitate more transactions, as opposed to those in the Bitcoin camp that agreed, but they didn't want to compromise decentralization. And lastly, we have XRP, which was created in 2012 by Ripple. And its primary use case is to be able to replace the SWIFT network and allow banks to transfer money instantaneously between each other. All right, next let's look at the privacy currencies group. So you may be wondering why these currencies are separate from the previous section, since their primary purpose is also to be used to transact. And really the reason is that since they focus so heavily on privacy, they've had to make trade-offs in their design that could compromise their ability to store value and to provide a meaningful amount of transaction throughput, really limiting their ability to scale. They're much slower and complex than the currencies in the previous slide, but they can provide full anonymity as a use case for people who need it. This could include political activists, those living in countries with oppressive governments, or just people who value their privacy when it comes to their financial transactions. The oldest privacy coin today is Monero, which was created in 2014 through a grassroots movement very similar to that of Bitcoin. The Monero protocol mixes all transactions with each other to achieve a meaningful level of privacy. Next, we have Zcash, which was created in 2016 and is the second most popular privacy coin. And it uses bleeding edge cryptography to achieve its anonymity. An important thing to note, however, is that Zcash's privacy is opt-in, whereas Monero's is not. This may seem like a small nuance, but it can have a very meaningful impact on, both the adoption and the ability of which will actually be used, whether or not it'll actually be used for privacy. And that's the exact reason why Zcash is commonly seen on exchanges, whereas Monero is not, primarily due to this opt-in feature. Next, we have Dash, which was created in 2014 as well. Dash utilizes a mixing service similar to that of Monero, albeit a little bit more centralized. One of the novel parts of Dash is that it has a structured governance that it uses to make changes to the protocol. And lastly, we have Grin, which was created recently, just in January of 2019. Grin utilizes a new form of privacy that has significantly less computational overhead than that of Monero or Zcash. So time will tell if it's able to pick up traction. All right, so next let's look at the crypto assets in the smart contracts platform group. So we touched briefly on smart contract platforms in our first webinar, but just to refresh, smart contracts were built to add native programming logic into the blockchain. This enables them to perform use cases that are just not possible for the cryptocurrencies we previously looked at. That being said, this is a group that sees a lot of innovation. So let's just take a look at a few. So the first is Ethereum, which was founded by Vitalik Buterin in 2015. Vitalik is probably one of the most important people in the crypto asset industry, and he devised and built Ethereum when he was only 19 years old. And really the reason he built it was because he was frustrated with the lack of programming capabilities of Bitcoin, and in turn, the Bitcoin community's lack of enthusiasm towards adding such capabilities. Therefore, I consider Ethereum as really the first smart contract platform, and it's currently the second largest cryptocurrency by market value. This also means that it has the largest community usage and mindshare out of this entire group. Next, we have Ethereum Classic, which, as you may guess, was a fork of Ethereum that occurred in 2016. So very similar to what happened with Bitcoin and Bitcoin Cash, the Ethereum community faced a contentious issue that ended up splitting the community into two, leaving us with the two coins you see there. Really, the source of the debate was questions around the immutability of the chain. The Ethereum community felt that it was all right to roll back changes in the early stages of the product, whereas the Ethereum Classic community felt that all transactions should be final. And Ethereum Classic has diverged from Ethereum over the last 4 years, but for the most part, it's still fairly similar, and it still maintains a community. The next smart contract platform we'll look at is Tezos. Tezos was created in 2018 as an alternative to Ethereum. Tezos has quite a few technical differences from Ethereum, but one of the largest is the governance structure that was set in place to manage the developer funds and upgrades to the platform. And lastly, we have EOS, which also went live in 2018. EOS's primary selling point is the amount of throughput that their blockchain can handle. Especially with well, really with all crypto assets, there's always a trade-off between decentralization and throughput. And EOS chose to go more on the throughput side. All right, so lastly, we'll look at the application tokens group. So this one's a little, somewhat different than the others in that there's a large, very large amount of subgroups, and I didn't list them all here due to the sheer number. However, this does add another level of decision making in that we need to not only determine which coins for a single use case we want to choose, but also we have to choose the use case itself. So for the application tokens, we chose 3 use cases that are currently very popular. File storage, data, and advertising. So Dan went over the use case for decentralized file storage in webinar 1, but just to recap, the aim of these coins is to become a network for people to rent out their unused computer storage. The first coin created for this purpose was Siacoin, which went live with its beta in 2015. There's also Filecoin, which raised 250 million in an ICO in 2017, but is yet to launch. This category also has a few coins that aren't listed here. It's a fairly crowded use case currently, and there's a lot of tricky technical issues that still remain to be solved. Next, we have the decentralized data use case, and Chainlink is the primary contender right now. This use case is pretty straightforward, but extremely important for really all crypto assets. And we discussed the difference between on-chain and off-chain data. And really what Chainlink is trying to do is to bring off-chain real-world data on-chain in a trustless, decentralized way. So for example, if a blockchain needs to determine the score of a basketball game, it can utilize Chainlink to be sure that the data is accurate and not manipulated in any way. And the last use case we're showing here is that of decentralized advertising, in which Basic Attention Token is the primary contender. And it's really aiming to become a network that facilitates the relationship between advertisers, websites, and consumers. So remember that diversification is important from the perspective of competition in a use case. An investment in a decentralized storage relies not just on the use case itself working, but also on the coin chosen to be the winner. This makes use cases with less competition potentially more appealing from an investment perspective. So just to recap, we've now looked at a variety of crypto assets by different groupings. The intention was so that we can be familiar with not just the asset groupings, but also a handful of less traditional assets. We'll now move into making the investment itself. So now that we have a solid framework for how to group different cryptocurrencies, we can now make a decision on how we want to structure and what assets we want in our portfolio. So our first step is determine which assets we want. So here would be a sample portfolio that we put together. And really this is where the subjectivity will enter the decision-making process. So first we selected Bitcoin, which is far and away the most popular cryptocurrency and seems to be gaining ground in this regard, especially with everything going on with COVID and the central banks kind of not quite sure what to do. Bitcoin and its store of value properties make it a pretty good contender for a portfolio. Next, in order to get some exposure to privacy coins, we chose Zcash. And this is really due to the increased exchange accessibility relative to Monero. It's much more difficult to purchase Monero right now just due to the fact that it's just not supported on very many exchanges. As for smart contract platforms, the first one we chose was Ethereum. And that's really due to its use as the base layer for a very quickly growing decentralized finance ecosystem. And then to hedge our smart contract bet a little bit, we also added in Tezos, which has been seeing some increased traction lately as well. And as for the application tokens, we chose Chainlink and BAT, both which happen to be the only coins competing for their specific use case. So now that we have the assets in our portfolio, I'll pass it off to Dan to go over how we're going to allocate to each one.
Great, thanks, Griffin. Hi, folks. My name is Dan Ayer. I'm the CEO of Blockchange. And I'm going to take you through essentially the different portfolio weighting strategies we could look at, and then how to essentially enter the investment, and then we'll look at managing the investment. That's where you get a peek of the Blockchange platform. We'll go through a live example. So portfolio weighting is really important because ultimately it really heavily influences your outcome. It's kind of like your starting point and thinking about your strategy, at least for long positions in how you're approaching the market and thinking about the market. So the first one that we have on here, equal weighting, you're really coming at that from a position of not knowing too much about, the advantages or disadvantages of different assets. This strategy does not have the best track record, just because it's kind of like peanut butter spread, right? Say you have 5 assets, each one of them is going to get a 20% allocation. So depending on how that plays out, you could do well, but you could also be really missing out on quite a bit of value. Next, we have Sharpe weighting. And essentially what the Sharpe ratio, for those that aren't familiar, is essentially a way of measuring the risk-adjusted returns. So seeing whether the returns are worth the higher volatility of an asset. In a Sharpe weighting strategy uses a proportional allocation to the assets based on their risk-adjusted returns. Next is going to be the Traynor weighting. And essentially, this is a really interesting method because for most assets in a portfolio, they're going to be, you're not going to know more about those assets than anyone else that might be investing in them. And they're kind of like, passive, kind of unknown in terms of a lot of the variables that influence their performance. But then, if you do know more about something and for whatever reason you think you can beat alpha on a couple of assets, there is like an optimal way to allocate to that, where you're essentially putting a higher allocation in the assets that you have more information about, and a lower allocation into the passive assets in that portfolio, to kind of hedge against like, well, what if you're wrong, And then after that, we have a return weighting. This one's really simple. It's just looking at historical returns and weighting the constituents of the portfolio. Their ideal allocations would be proportional to how well they'd performed from a returns perspective. Second to last here is the Markowitz weighting. And this essentially utilizes ideal allocations by which the portfolio achieves an expected rate of return, like an acceptable expected rate of return with minimal volatility. And so this one is like just approaching it from, kind of slow and steady wins the race, not taking huge risks, but making sure that you're taking just enough risk to accomplish your goals. And then the last example, and this is actually the one that we're going to use, for the example that we show you here today, is market cap weighted. And this is really popular in the digital asset space just because historically it's proven to be a pretty effective method in that, the largest assets continue to see at this point in the ecosystem life cycle, it's almost like a self-fulfilling prophecy, right? The biggest projects are seeing a lot of traction, the communities are growing, and they're continuing to outperform many of the smaller projects. Although that's not always the case, which is why it is important to continue to diversify. Okay, so now that we've determined our portfolio weighting strategy, which is the market cap weighted, we need to identify the manner in which we're going to make the investment, actually putting money in, right? And of course, it's possible to place all buy orders at once. Depending on your circumstances, that might be what you do. Although there are some tried and true methodologies that have proven superior in terms of returns. And the first of these is dollar cost averaging. Now, there's a few reasons that you might do dollar cost averaging or take that approach. First, it enables investors to buy the dip without calling it. And the interesting thing there is most of the time, if you try and call a dip, you're going to get it wrong. But if you have a consistent strategy of buying in increments over a longer period of time, you're going to realize you're going to buy the dip, but it's just not, you're not going to buy the dip with your entire sum, with the entire principal that you're looking to invest. But other than buying a dip, there's just also, prevents excess exposure to price volatility. You can kind of protect yourself from, especially in a more volatile environment like digital assets, as opposed to, bonds or equities. It's a good way to kind of spread that risk a little bit. And then lastly, and this kind of relates to the other two, it's just pretty good for your mental health stability. Knowing that, the investments that you're making are according to a strategy, right? Like not kicking yourself thinking, well, I should have done it at this time. or I should have done it at that time. No, you've got a strategy, you're following it, you're going to feel good about that decision. So the next method for making the investment, I actually find this one pretty interesting, is value averaging. And research suggests that value averaging is actually, can be more effective than dollar cost averaging. And essentially by setting a target value in growth rate, we can chart the value path over time, which you can see there is the very dark kind of straight diagonal line. And that provides like an implicit buy and sell signal for investments or divestments to come as close to the value path as possible. All right, so anytime you're like deviating too much from that, you want to rebalance to get back on the path. And that ensures that we're not buying too high or selling too low by keeping us like right around that expected range. And of course, this requires enough information to determine the target value and expected growth rate. So it'll work well with investments in more mature projects, but for smaller projects, you might want to, consider sticking to dollar cost averaging. So now we're going to look at managing the investment. So the assumption here now is that we're applying all of the different things, the coins that Griffin had selected, and we're going to use some of the methodologies that I was speaking about, and some like high level items that I'm going to cover are going to be ideal allocation, allocating by group, rebalancing, and cash management. So let me start sharing here. Okay, and I'm just going to assume that everyone can see my screen. Okay, so what you're seeing here, I'm logging into the BlockChange platform. And once you log into BlockChange, there's a couple things that you're going to see. One is from an advisor perspective, which is really the user role that we're in right now. On the left-hand side here, we have kind of information that's aggregated across all different clients. So the total AUM, the sub-account distribution according to client, historical performance, which you can look at different time horizons, and then aggregate asset distribution across all the client base. We're not going to be too focused on the advisor view here. We're actually going to dive into one of the sub-accounts that's on the right-hand side here for a specific client, right? And we're going to look at their portfolio. And we're going to dive through a number of those different concepts. So let's look at me, because I'm right here. So I've jumped into my particular portfolio, and over here on the left we see that this pane updates to be specific to my portfolio. Of course, this is just still informational. Over here on the right is where the bulk of the the work is going to be done. Think of it like the workspace. So for my particular portfolio, you can see that we've got allocations to a number of different groups, right? You can think of these like strategies. And each one of these strategies has an ideal allocation and an actual allocation. And the actual allocation is how much I'm holding right now of the assets that sit inside of each one of these groups. And the ideal allocation is, of my portfolio, thematically, how much would I actually like it to be? So when you think about like value averaging or things like that, this is the amount that you want. And when you rebalance, that's where you want to get close to. And you can see here, that's the calculated variance. So a number of these, strategies or groups are off from where I want them to be. And there are a number of things that can cause that, right? I could see price growth in some assets and not in others. And that's going to throw off, kind of throw that out of whack. And that's why it's important to keep rebalancing, to stick to a strategy. But, you'll also notice that I have bucketed those assets that Griffin had picked. For currencies, it's Bitcoin and Zcash. For smart contract platforms, it's Ethereum and Tezos. And for utility tokens or application tokens, it's BAT and Link. And so, basically when I'm looking at this particular portfolio, I want some objectivity in the distribution of my investments. So you can see here, I've got like 92% and 8%, which is pretty close to market cap weighted. for Bitcoin and Zcash, considering Bitcoin is so much larger. But then I also want some subjectivity in terms of what I want to allocate to the groups. Like obviously currencies are a much bigger, much bigger portion of the whole market cap of digital assets versus, smart contract platforms or utility tokens, right? But, I'm making some strategic kind of thematic investments based on what I think some of the broader trends are going to be. And so let's look at, kind of changing some of these a little bit. So if I wanted to get to my ideal allocation, it's something that I'm going to want to rebalance to, and we'll do that in just a second. But in this case, I want to do a couple things. I want to bump up my currency allocation because I do think somewhere around 60% is appropriate there. And then, I do want to put somewhere around I want to dollar cost average a little bit more in. So I'm coming down from, the 10% or so I had on there. I'm going to go down to 5%. I'm going to put 5% of the cash reserves I have in here into, these other categories. And the other nice thing about having, a cash reserve that you can manage here is if you do have some kind of set aside, it can enable you to very quickly get into other positions and buy dips as they happen, right? So I'm going to hold that value there. And then for smart contract platforms, utility tokens, I'll bump this down, let's say to 25% and 10%. And then obviously all the assets that sit in here, their proportions stay the same, right? Because I still want them to be market cap weighted, although I could adjust them if I wanted to. But in a single rebalance event, I'm going to confirm and rebalance that. And that's essentially bringing me back to my actual allocation is now the same as my ideal allocation. So we don't have any variance anymore. And now, all of the rebalance events, all the trades, everything related to rebalancing those assets has taken place. Now, I would say that, it's also important once you've been managing those assets to continue actively monitoring those investments. So, things happen quickly in this space. And you're going to want to make sure that you're kind of looking out for the adoption curve. And we talked about this last time. It's not just developer activity. It's, the number of addresses on the network and, various on-chain metrics and off-chain metrics. But adoption is something that you really want to track just because the community aspect, it being global, but also like a central point of identifying momentum in the space, you're going to want to monitor adoption. And then separately, competitors emerge in this place, in this space, pretty quickly. There are a lot of competing projects out there, and you shouldn't think of it as, well, that project is going to kill my project. It's really just an opportunity to diversify, because one of them is going to really win and hit it big potentially, and you just want to make sure that you're diversified enough that you can take advantage of that. So as a quick recap, we covered how to research potential digital asset investments using classification and taxonomy, as Griffin went over in the beginning. And there's a whole lot more on how to analyze these investments and prepare to make the investment from our other webinars, parts 1, 2, and 3. And I would encourage you, if you haven't seen them yet, to take a look at those. After that, we went into defining the investment weighting strategy and entry point. And then we made the investment, right? What strategy we were going to use that, which was the value averaging, dollar cost averaging. And then we showed a little bit of how to manage the investment with ideal allocations, group level allocations, rebalancing, and cash management. So with that, I am going to break here, and we're going to go into a Q&A section for a little bit.
Great, thank you, Dan. So we do have some questions here from the audience. The first one is regarding the platform. So the platform that you demoed looks really interesting. What are some of the other things you can do with it?
Yeah, I mean, so there's things like automated rebalancing. You do some advanced back testing, building portfolios and back testing them. Maintain like a firm level strategy library where you can have strategies that various advisors within the firm can pull from for various clients, so that they don't have to manage each account individually. They can just kind of follow the library the strategy for the overall firm. And then, of course, tools for technical analysis, integrated reporting, news aggregation, sentiment analysis, and there's a number of other things like multi-level transaction logs and that type of stuff. So there's a lot in there. If you want to check it out, we're more than happy to share.
Yeah, actually, also I'd mentioned to everyone that if you want to see a recording of a demo of the platform, check your email when we send out the link for the webinar recording, because that email will also include a link that will take you to the recording of a demo that Dan did just recently. Gives a really good idea of the basic platform capabilities. Okay, Griffin, this one's for you. If I want to choose the right combination of coins for the best returns, how would I go about this with the best balance and diversified exposure?
Yeah, I mean, well, sort of like what I said in the first part, it's really about hedging your risk for a specific use case, right? So, and I think that's especially apparent for a group like the smart contract platforms. There's so many current or crypto assets that come out that kind of market themselves as the Ethereum killer, which may or may not be true. So far, it hasn't been, really so far. But just to be aware of that, and to allocate a certain portion to competitors is important.
Okay, Griffin, thanks. So this one just came in. Do the portfolio weighting strategies have parallels in traditional asset investing that you can point to?
Yeah, I mean, you could think of it like, at the group level, potentially like allocating to stocks versus bonds. And then, the level below that we were looking at with the individual assets, you can think of that as like different stocks, or potentially like municipal versus corporate bonds or something like that. So there aren't exact parallels, but there's some similarities in how you would approach it.
Okay, Dan, this one I think is for you as well. As far as liquidity, would you say investing in tokens would be the smartest route to initially start engaging in versus ICOs, because the ICOs may offer me a better return but have a higher potential to fold?
Yeah, so I mean, ICOs are not liquid for quite some time after they raise through the token sales. And even after they hit the exchanges, the volume really takes a while to build and usually isn't good for them when they hit the exchange, because a lot of people want to sell. So it is usually better to invest in projects that have traction, where you're kind of investing in a known entity. It's a lot lower risk. And in addition, one thing to consider is that some ICOs at the moment are actually unregistered securities. And while you might think that they pass the Howey test, I mean, it's very, I think it's still kind of regulatory hot water. And so I would avoid getting, mixed up in ICOs if you're not, fully sure that they are decentralized enough and decoupled enough from the success of one particular group of people or organization. I would focus on known projects.
Thanks, Dan. I do want to remind everyone as well, the disclaimer that we mentioned at the beginning, that we're not offering any investment advice on this webinar, and anything you hear from us is purely informational. Okay, Griffin, next one for you. What would you say is the best route? Take a risk and invest in new coins added to exchanges, or play it safe and invest in the tried and true top coins?
Yeah, I mean, always I'd never buy something that you don't understand. And so naturally the more prominent and I guess dominant coins are more understood by most people. So in that sense, you don't want to be buying something because it's new and shiny unless you have a fairly structured thesis on what it is and how it fits into the portfolio as a whole. So, but that is it's a common thing too, because especially, well, it's not quite as bad anymore, but it used to be the case where, especially when Coinbase only had like, or any of the exchanges, Gemini, they had like one or two assets. So when they added a new one, that asset pumped, but that's not necessarily a good reason to invest in a coin, right? Is because it just got added to an exchange. You should always be aware of the use case that it's going for, and how it fits into your portfolio.
Okay, I think this one's for you as well, Griffin. Is your strategy around consistently beating Bitcoin?
Yeah, so I think this, or the way I think about this is very similar to the debate kind of in traditional equities, right? Which uses the S&P as your benchmark, right? If you have a portfolio that fails to beat the S&P, then that's not a very good portfolio, because you might as well have just bought the market. You know, I don't think it's quite exactly the same in crypto land, because again, like they are so different. But I think looking at Bitcoin, or even like maybe a top 10 market cap as an index, is definitely useful for determining, you know, your investment decisions going into the future.
Thanks, Griffin. Dan, how do I actually determine which specific coins to buy? It's overwhelming.
Yes, so if you're joining us for the first time in the webinar series today, it is part 4. I would recommend checking out parts 1 through 3 to get a really strong foundation on, use case definition, correlations, volatility, fundamentals, and example investments. We even look at, 2 and 5% allocation to Bitcoin with some common portfolios that you might see in, for average everyday people, and look at the performance over 5 years. So, I mean, there's, I would say that while we're not giving financial advice here, and we're not going to name specific coins other than just the examples that we gave today, which were just examples, I would say you want to approach it with a framework, and that's what we've developed and shared over the 4 webinars here. So I would encourage you to go and look at those, watch them.
And on that note, when we send out the email, should be on Monday, with the link to this recording, we'll have the links for all 4 recordings, so you can go back and look at those at your leisure. So this looks like this is the last question for you, Griffin. Would you say your investment philosophy is more long-term returns or short-term pains? Oh, sorry, excuse me, short-term gains.
Yeah. Well, you probably didn't even need to adjust your statement, because that's really what the short-term mindset will get you. Because especially when you're looking at an industry like this, where the result of what's going to happen is so uncertain, it's imperative to maintain a long-term position. I mean, almost all of the, and this is also true with traditionals, right? I mean, what's the Buffett saying of how, you should never invest in anything that you wouldn't hold for 5 years, 10 years? I think the same holds true here as well. That being said, there's a lot of traders and chartists out there, and they seem to do well, maybe. But I think when it comes to portfolio management and actually building a portfolio, the only mindset you can have is long-term.
Okay, thanks, Griffin. So it looks like that's the end of questions. Actually, we have one more. Let's have a look. So day traders need to be consistently tuned in to react in just a few seconds, because if you were late, it could make the difference between profit and loss. Do you have an app?
So, our platform, while it can enable you to make, a number of trades very quickly across many different assets in different groups, our product is primarily dedicated to enabling wealth advisors, RIAs, manage many clients very easily in a separately managed account structure. which is fundamentally different than, if you look at like some of the unified trading interfaces out there and, the advanced trading capabilities on some of the exchanges. We're not focused so much on, the individual trade, where, you might see like a hedge fund kind of pulling all the investments together and making, decisions on the fly after doing some analysis and being really tuned in, as mentioned. But we're really focused on kind of productivity at a, more individual account level for wealth managers.
Okay, so that really is the last question now, I believe. Just checking. Yep. Okay, so that's the end of today's webinar, everyone. And it's actually the end of the whole 4-part webinar series. So I'd like to thank you all for joining. And also thanks to Griffin for sharing thanks to Dan and Griffin for sharing their insights. So as I said before, we will be sharing the recording of today's webinar with you. And in fact, we'll be emailing you the links to the recordings for the entire series so you can review those at your leisure. If you have any questions, please email us at support@blockchange.ai, and we'll be very happy to answer those for you. We also invite you to visit our website at blockchange.ai to learn more about the Blockchange platform. So thank you, everyone, and enjoy the rest of your day and your weekend.
Thanks all.